In November 2022, $8 billion vanished overnight. Not from a bank vault, not from a government treasury, from ordinary people, teachers, students, retirees, who trusted one company with their savings. The man responsible was a 30-year-old in cargo shorts who convinced the world he was the future of finance. His name was Sam Bankman-Fried. His company was FTX. And what he did with your money is one of the largest financial frauds in American history. This is the full story. Sam Bankman-Fried, SBF as the media loved to call him, graduated from MIT in 2014 with a degree in physics. He didn't go to Silicon Valley. He went to Wall Street, specifically Jane Street Capital, one of the most secretive and profitable trading firms on the planet. At Jane Street, he learned something that would define his career: how to exploit price differences across markets. Buy low here, sell high there. Arbitrage. It's not glamorous, but it prints money. In 2017, he noticed something wild. Bitcoin was trading at different prices on different exchanges around the world. In Japan, it was sometimes 10% higher than in the US. 10% on an asset doing billions in volume. So, in November 2017, he quit Jane Street and started Alameda Research, a crypto trading firm designed to exploit exactly this kind of inefficiency. Within months, Alameda was reportedly moving $25 million a day. But here's the thing about SBF. Trading wasn't enough. He wanted to own the casino. In 2019, SBF launched FTX, a cryptocurrency exchange where people could buy, sell, and trade crypto. Think of it like a stock exchange, but for digital assets. No regulations, no SEC breathing down your neck, just pure, unfiltered financial Wild West. And FTX was good. The platform was fast, the fees were low, and SBF marketed it like a tech startup on steroids. He paid Tom Brady $55 million for an endorsement deal. Gisele Bündchen got $20 million. Steph Curry, Shaq, Larry David, all of them appeared in FTX commercials during the Super Bowl. He bought the naming rights to the Miami Heat's arena for $135 million. He hosted a conference in the Bahamas where Bill Clinton and Tony Blair showed up to shake hands. He testified before Congress, in cargo shorts, positioning himself as the good billionaire who wanted crypto regulation. The adults in the room loved him. Here was a young genius who actually wanted rules. By 2022, FTX was the third largest crypto exchange in the world. Over 1 million users, a $32 billion valuation, and SBF's personal net worth? $16 billion. But behind the Super Bowl ads and the congressional handshakes, the money was already gone. Here's what nobody knew. FTX and Alameda Research were supposed to be separate companies. FTX was the exchange. It held customer deposits. Alameda was the trading firm. It made risky bets on crypto markets. In reality, they were the same thing. SBF had built a secret backdoor, literally a line of code, that allowed Alameda to quietly borrow from FTX's customer funds. Not millions, billions. When Alameda's trades went bad in the May 2022 crypto crash, instead of taking the loss, SBF just took his customers' money to cover it. $8 billion. Gone. Moved from FTX customer accounts to Alameda to plug the hole. And the software was designed to hide it. FTX had a special exemption built into its accounting system that excluded Alameda from the normal balance checks every other user had to follow. While customers thought their money was safe, SBF was living in a $30 million penthouse in Nassau. 5 bedrooms, 7.5 baths, a rooftop pool. He bought $93 million worth of political donations, making over 300 illegal campaign contributions to both Democrats and Republicans. His ex-girlfriend, Caroline Ellison, was running Alameda. His college roommates held the other C-suite positions. The entire empire was run by a handful of 20-somethings living together in the Bahamas, playing League of Legends between billion-dollar decisions. On November 2, 2022, a reporter at CoinDesk published an article that would light the fuse. The article revealed that Alameda Research's balance sheet was stuffed with FTT, a token that FTX itself had created. In other words, Alameda's assets were largely monopoly money printed by its sister company. Changpeng Zhao, CZ, the CEO of Binance, FTX's biggest rival, read that article. And he tweeted 6 words that started a bank run. "We have decided to liquidate our FTT." Binance held $580 million worth of FTT. When CZ announced the sell-off, panic erupted. FTX customers rushed to withdraw their funds. $6 billion in withdrawal requests hit FTX in just 72 hours. And the money wasn't there. On November 8th, Binance swooped in with an offer to buy FTX. For a few hours, it looked like a rescue. Then, Binance looked at the books. They walked away the next day. The hole was too big. On November 11th, 2022, FTX, Alameda Research, and over 130 affiliated companies filed for bankruptcy. SBF resigned. John J. Ray III, the same lawyer who cleaned up Enron, was brought in to sort through the wreckage. His first public statement? "Never in my career have I seen such a complete failure of corporate controls. The man who unwound Enron said FTX was worse." On December 12th, SBF was arrested in the Bahamas. He was extradited to the US and charged with 7 federal crimes: wire fraud, securities fraud, commodities fraud, money laundering, and campaign finance violations. His trial began in October 2023. His ex-girlfriend, Caroline Ellison, took the stand against him. So did his former roommates. One by one, the people closest to him told the jury exactly how the scheme worked. On November 2nd, 2023, exactly 1 year after the CoinDesk article that started it all, Sam Bankman-Fried was found guilty on all 7 charges. In March 2024, he was sentenced to 25 years in federal prison. He was ordered to forfeit $11 billion. Caroline Ellison got 2 years for cooperating. The others, Nishad Singh, Gary Wang, got reduced sentences for flipping. And the victims? As of early 2026, the FTX bankruptcy estate has recovered between $14.7 and $16.5 billion through liquidating assets, including FTX's stake in Anthropic, the AI company, and shares in Robinhood. 3 rounds of payouts totaling $7.1 billion have gone out to creditors. Smaller claimants are actually getting back 120% of what they lost because crypto prices rose during the bankruptcy process. Sam Bankman-Fried didn't steal $8 billion with a gun or a mask. He stole it with a laptop, a line of code, and the most powerful weapon in finance: trust. He looked like a nerd. He talked about effective altruism. He said he wanted to earn money just to give it away. And the world believed him. The investors, the regulators, the celebrities, Congress itself. The FTX arena is gone now. The celebrity endorsement deals are in litigation. The $30 million penthouse was sold off by the bankruptcy estate. And somewhere in a federal prison, a 32-year-old in an orange jumpsuit has 25 years to think about what trust is really worth. In the end, the biggest scam in crypto wasn't about crypto at all. It was about believing that someone too smart to fail was too good to steal.